what did you make of what the Saudis did yesterday?
Well, we had the market in a deficit by June in any case. This will help with the margin going forward. But I think the bigger news out of Saudi Arabia was the announcement of some of those much stricter fiscal policies over the weekend, which indicates that, hey, there's a lot of stress going on in Saudi Arabia now, and anything they can do to get the price up and get their income up will help the situation. But in terms of looking at oil market fundamentals, right now we think demand is down about 17 million barrels per day globally relative to pre-crisis levels. Call that 100 million barrel per day base, so we're down about 17%. The cuts thus far, including both necessary and voluntary, were worth probably somewhere around 10 million barrels per day. So this starts to close that gap, but you still need demand to recover, which is our base case between recovering demand and further cuts, both economic as well as voluntary, get this market into a deficit by June. Where this really matters is when we start to draw the inventories in third quarter and fourth quarter, because it will definitely speed up that pace.
Do you have a read yet on if the cut will draw any of that forward, like the demand, like the lack of stock builds, maybe even stock draws, or does it just create a kind of floor here?
Well, if you look at, actually I like to think about there's a ceiling on prices now as opposed to a floor. And the reason for that, if you listen to the U.S. producers, they've said high 20s, low 30s on a WTI basis. They're back to producing oil again, but they need it more on a sustainable basis. So what that tells you is you get up to, let's say, 30, 32 on Brent, the 28 range on WTI. And if you stay there for a while, you could start to create an incentive for some of these producers to come back. Our base case is this market trades at $30 a barrel Brent basis throughout third quarter. We draw 450 million barrels, most of the high-cost floating storage first, and then we can inch up to a $40 price in 4Q, at which point we draw another 400 million barrels, but most of this being on land, lower cost. So you're kind of working up that supply curve of inventory. But the key point is you've got to keep that production out of the market, and the only way you keep that production out of the market is keep prices relatively stable where they are. Where we think there'll be price action is the curve will flatten out as you draw those inventories. And again, this announcement yesterday will speed up that process as we go to 3 and 4Q. But in no way does it suggest this market can trade higher tomorrow. It'll just speed up the time process in which you get the market out from underneath this very high inventory bill, which we think market built somewhere around 1.1 billion barrels during that February, March, and early April time period.
So, Jeff, drill down a little bit more into the reaction function for shale producers. We had an article out in the Bloomberg that said the Energy Transfer's pipe network is starting to see more oil come through. There was about 8% of oil volumes that's been shut, and they see about 25% of that already turned back on. Is it possible to do it that fast, just when oil is still $25?
No, I think what it is, congestion in the system is starting to be freed up. And allowing barrels to fly. I liken it to like you're driving down the freeway and you get into a traffic jam. You sit there for a while, then you start moving again. And I think you go back to late April and the first part of this month. You had a tidal wave of surplus moving through the global oil transportation system, which was creating bottlenecks everywhere because of the improvement in demand, because of the production cuts that have occurred. This is likely slowed. You look at the high-frequency satellite data, it suggested in, late to mid-April, we're running 25 million barrel per day surplus globally. That shrank to 3 to 6 million barrels per day and on its way to zero right now. So, of course, you can think about it as traffic, you're going to start being able to move more barrels through transportation systems. But I think the bigger question here is what happens to the different segments within the U.S. shale players. And you can see it in the bond prices. You look at fallen angel high yields, they've actually performed well because the probability of them going bankrupt are relatively low. But if you look at that group below them, the legacy high yields, they've struggled much more so, which is an indication the market sees there's real serious problems in that segment.
Do you think, though, that Saudi action, as they try and save themselves, basically, will save some of those distressed shale guys?
Because it's more of an attrition game here over time than it is anything else. Because will that action they did today create a sustainable rise in prices given the magnitude of this event? The answer is no. But can it help speed up the time in which you get to higher prices? Yes. But when we look at many of those players, they don't have the liquidity to survive until, let's say, 1Q, 2Q of next year. Now, look at the borrowing base cuts. They're, some of them are up to 50%, 25% for many of the oil E&Ps on average. The liquidity is down tremendously, not only because of the lack of a borrowing base, but because of the low prices. So, it's that ability to survive this. It's just really not there right now.
And then to move forward sort of the demand picture, and you touched on this earlier, but did you see the Saudi Arabia cut was maybe a commentary on OPEC Plus non-compliance? Was it a demand non-recovery story, or did you really see it as the Saudis needing to improve their own fiscal situation?
I just found it interesting. It came off of the back of those fiscal austerity measures. Within one day, half a day separation between the two. So I would view it I viewed it more as a response to those austerity measures than anything else. But those were a tough pill to swallow. They were significant.
Yeah, and they have to keep their population happy at the same time. So then, Jeff, if you're looking at the whole commodity space, as we're still uncertain about the demand recovery and we're still trying to deal with the storage issues for oil, do you have a favorite commodity trade?
At this point right now, we still really like gold. There's a lot of reasons still to own gold. I think foremost is that you're still seeing the debasement effects of all the stimulus going on, not only in the U.S. dollar-based economy, but also more broadly globally. But there's another important point that comes out of this recovery, and you can see it in the data everywhere. Construction, manufacturing are leading the way. Why? These are activities that cannot be done from home. We've seen many of these people put back to work around the globe. What we witnessed in China was, that you saw infrastructure, construction, and manufacturing leading, services and consumer goods lagging. And that would suggest you want to be long CapEx commodities and short the OPEX commodities. Obviously, a lot of that's played out when you look at iron ore trading at $60 to $86 a ton right now. But we think there's other markets where you're seeing it beginning to play out, which would be in copper. My one caveat is you still haven't priced in the weakness in ex-China in terms of exports going to China. I think that's the one issue that's a risk to these CapEx commodities. But nonetheless, everywhere we look at in the world, even in Boris Johnson's comments over Sunday here in the UK, put the construction workers and manufacturers back into their workplace, which means more demand for capital goods type commodities.